Hi, everybody. I'm Al Ganoza. Today I'm meeting with Paul Fair of Paul Fair Associates, a retirement and income solutions firm. And Paul, tell me about you, your investment philosophy, and a philosophy for investors and retirees.
Well, thanks, Al. I have over 23 years experience working with retirees and the soon to retire, uh, and individuals that provide solutions to help them in their retirement and their challenges that they have in retirement.
Now, what do you mean by challenges and solutions?
Well, people as they get closer to retirement uh, change ideas about their money. Okay, they want it to last. So there's always a challenge to that. You have inflation. We want when you have money in the market, you want to prevent losses because you want the money to be there and to last as long as you're going to last. So that's a challenge, and solutions are help to smooth that out and to put people in programs that can give them a better opportunity for the money to last as long as they last.
I guess the challenge always is how do you get competitive returns while reducing your losses?
Well, years ago you could go put money in the bank and make 5-6% all guaranteed, and it worked out. Today the bank rates are so low, people are willing to take a little bit more risk and to try to make better money mostly in the market. Some of the problems that they run into is the volatility of the market. If we look at the market over the past 15 years, it's been all over the place. And it really doesn't look like that's going to change anytime in the near future about the ups and downs of the market.
Okay, and I guess the question is, can you give us an example of a managed portfolio?
Let's talk about the professionally managed fixed income total return portfolio. This is a portfolio that is I use from a company called Clark Capital. If you take a look at this slide, you'll see that there's a circle on it, and there's three different areas. The first area is a dark blue, a yellow, and a gray, or a light blue, I should say. This is a tactical portfolio where they're actually going to allocate money to different parts of fixed income and rotate it to wherever the money's being made. When we look at that, the first area that will come up, in the blue box you have short-term treasuries. This is used when there's volatility in the market and you're trying to protect your assets. The second box is the yellow box, and this is a box that's made primarily of longer-term treasuries and high-quality bonds. Sometimes there's use for this. And the last box is the blue box. And in the blue box, you have mostly high-yield bonds. These are bonds that pay a high dividend, lower quality, and will rotate between the different sectors depending on what's going on at the marketplace and what the market dictates where they go. Let's take a look at a snapshot of the portfolio on March 31st at the end of the quarter 2013. If you take a look at this, we'll look at the holdings of the portfolio first. And at this point in time, the holdings were 93% in high-yield bonds. The second part was a little bit, 5% in preferred stocks, which are like a hybrid between stocks and bonds, and in cash, 3%. The second part you see is the characteristics of the portfolios. And you can see it has quite a few holdings in it, and it gives you the average yield or the dividends that are being paid. And this is paying somewhere in the 6% area as far as dividends go. So they will change this as time goes on. Sometimes the dividends are a little higher. Whenever you're in the short term, protecting the principal, it's going to be a bit less. The next area that we look at, if you look at this large blue box here, or the large box, this was the holdings that this portfolio had from the time it started, January 1st, 2005, until present day. And this is all color-coded to the same circle that we looked at in rotating the bonds. The dark blue represents when you're in high-yield bonds.
Mm-hmm.
The light blue is when they're in the short-term treasuries, and the yellow is when they're in the longer-term government bonds, treasuries, or in corporate bonds, or high-quality corporate bonds. If we look at this, you'll see a red arrow. This red arrow, this is really, to me, one of the most important parts of this whole program. Because if you look at that, you look at the dates of that, you're looking at 2008, mid-2008 to the end of 2009. If you remember the market back at that time, and I'm not talking about the stock market, I'm talking about all the markets, the stock market, the bond markets, everything was getting clobbered. Nobody knew what was going on, and this portfolio went to cash. Now, during that period of time, the S&P 500 dropped about 40%. At the same time, the high-yield bond index had dropped somewhere around 30%. This portfolio went to cash and didn't lose money. As a matter of fact, for 2008, this portfolio made somewhere in the neighborhood of 2% for the year.
And when you say go to cash, you mean to just take it out in the sidelines, but it doesn't lose any value there?
Right. They switched it from high-yield bonds, which was in just before that, the quarter before, and they put it into the short-term treasuries. Now, the short-term treasuries didn't pay much. They're like a money market. They're paying 0.1%, but which would you rather have? Something that's paying 0.1% or something that lost 20 or 30 or 40%?
So the so-called safe haven, right?
Exactly right. Moved it over and took care of business. The next chart we look at here, if you look at the chart, you'll see a red line, and that's the Barclay High Yield Index. So every portfolio that I know of, what you want to look at is a benchmark. If it were in stocks, you'd use the S&P 500 as a benchmark, or at least a number of people would. In this case, we're using the Barclay High Yield Index as a benchmark to see how the portfolio does compared against the benchmark. So if you look at this, and the first, when you look at the red circle, you can see that during that period of time, the index took a pretty good dip. If you look at the next slide, the blue circle shows what this portfolio did. And you can see it really didn't go down much at all. As a matter of fact, maybe took a little dip back in 2009 when they got back into the bond market. Now, if we look down here in the green box, what you're looking at here is the standard deviation and return. This has had very good competitive returns, but the deviation is low compared to the index. The index had a deviation of 11. The higher the number, the higher the swings of the gains and the losses. What I have found is most people that invest in the market, especially when they're retired, they get very concerned about their money. So consistency is an important factor. One of the things that I've found is if a person gets a 15% gain, they get pleasure. They get a 7% loss, they get pain. The 7% loss pain outweighs the 15% pleasure, especially when you're retired, because you're not putting money into your retirement system any longer. And while you're doing this, it sometimes negates what's going on in the market. So if you had a 401k and you're putting money into it and you lost 30% at the end of the year and the market was down 40, you think you did okay, but that's because you put 10% into it. That's the problem. The next slide is a bar chart. Now, this is the same chart that you just looked at, only in a different format. The other one is more graphic. This is more just bars. If you look there in the red circle, you'll see that the benchmark, which is, in this case, the high-yield bond, Barclay High-Yield Bond Index, dropped 26%. The blue bar right next to it is this portfolio, net of fees, and that made 1.08%. And by the way, one thing I just want to point out on this, actually the gains on these charts are all lower than what they actually are because due to compliance reasons, all the net fees are set up at a certain level, 3%, when the actual management fees are considerably less than that. If you look at the next chart, here with the green circles, we'll see that in 2009, the portfolios came back, the benchmarks came back. The benchmark was up 59%. That's pretty good roaring back, minus 26 plus 20 plus 59. And this portfolio made 38% that year.
Wow,
so
that's a good return.
Well, yeah. You know what? During that time, though, the S&P 500 for 2008 lost about 37%, and in 2009 it only made about 26%. It didn't roar back like this did. This chart picks out 3 years, 2007, 2008. And it's got a minus 26 and a plus 50 something and a plus 15 for the index. And the portfolio did a plus 1, a plus 20, a plus 37, and a plus 11. If you would have invested $100,000 in the portfolio at the beginning of 2007, at the end of 2009, that $100,000 would have been worth $155,000, whereas the index would have been worth $134,000. But which would you rather have? You started off with a 26% loss and then got a 59% gain? Or would you rather have something that was more consistent and you made more money to boot? That's especially important if you're drawing money out of an account. Because if the account goes down and you draw money out, let's say you're drawing $500 a month out of an account, and the market goes down, you're actually drawing out more money than that because the account went down, and you're compounding the problem.
And that's how a lot of people live as they get older, right? Drawing out of an account.
Absolutely, sure. Well, that's what the money's for, especially IRAs and 401ks and so forth. Now, this next chart just talks about drawdown. Let's talk about what a drawdown is. Let's define that. A drawdown is anytime the market is at a point that it starts down. The drawdown is how far it went down and how long it took to get back to the point that it started going down from. So if you look at this chart, it starts at 0. There is no gains in it. It's only saying, no, the market's doing fine. So if we look at the first box, we can see that the drawdown on the index, which is in red, dropped 33%, and it took about a year and a half for it to get back to even. So that's pretty good. That's significant, especially if you had $200,000 in the market and your account dropped $66,000. I would have to think that would get your attention.
Yeah.
Now, this is a drawdown on this portfolio. Now you can see the box is a little bit smaller. The largest drawdown it had was a little bit around 5%, and the drawdown lasted about 3 quarters or 3/4 of a year. And you can see it was a much less drawdown. The following chart just puts them together side by side, compare for yourself. If we look at this, which would you rather have? Something that was unmanaged or something that was and you had better returns, less volatility? I would think you'd probably go with the less volatility and better returns. This company that manages this money, Clark Capital, I use them basically for fixed income portfolios. They have a 4-star rating. Morningstar, a lot of people don't realize, but Morningstar rates stocks, bonds, and mutual funds. But they also rate money managers. So in Clark Capital's position, their fixed income portfolios, all of them put together, average out to about 4 stars. If you look at the next slide, this one here just talks about or shows you the portfolio we just went over. Morningstar rates it as 5 stars. And by the way, this is as of December 31st, 2011, this slide relates to. This was the portfolio from 2011 going backwards to 2007. And it averaged 13% a year, 13% a year for 5 years, when the index did 6.5%. This was rated in the number one peer group of all the fixed income managers in the entire country. They beat 99% of all the other money managers and taxable fixed income portfolios in the whole country. One thing I didn't mention was, besides this portfolio with them, with the high yield income, also they do a very good job with the muni bond portfolios, not mutual funds, but individual muni bond portfolios, and also in just regular corporate and corporate bonds also. So for fixed income, I think it's a great place to have your money.
It would seem to me, and maybe you know, are people skittish after what happened? I mean, it's been, what, 4 or 5 years, and are people still a little leery about their money?
Well, like a cat in a room with 9 rocking chairs. They're skittish. I asked the question to people, do you think we're out of the woods yet? You think the market's going to just keep going up from here. And the basic answer I get from them, I don't know of anybody, and that's not me, it's them saying, I don't know of anybody that thinks that.
Yeah.
Because they start and they say, well, you know, there's $17 trillion in debt now, and whatever the number is, and unemployment and everything else. People, they're still concerned out there. And you go over the past, since 2000, just look at it, up and down, up and down, up and down. Now, we happen to be up now, and things are doing very well, but how long will that last? That's why the actual allocation, the proper allocation at the proper time is so important. You can buy something and hold it and hope it works. I'm not saying we're going back to the Great Depression, but in 1929, during the Depression, the market went down. It didn't get back to even. The drawdown was until about 1954, 1955, and that's assuming that you never took a penny out of there, and it's assuming there was no such thing as inflation. So would you think $1 in 1950 bought more or less than it did in 29? Well, in 29 it certainly had more buying power. So we can go through significant issues, and when you're retired, you want to protect your money. Remember about the gain and the pain. The pain shows up a lot more than the gain does. Where do we go from here? If you're looking at this on my this video on my website, there's a place where you can download the whole piece on this that you just went through. I picked out some of the charts and some of those things, but there's a whole report on that's up to date. So if you're looking at this, it'll give you right up to date information. If you'd like to talk about this portfolio, get further information, here's my information, my website, my name, my address, Paul Fair. I'm in Sinking Springs near Reading, Pennsylvania, and I work with retirees, and I help them with solutions for their retirement. Now, let's talk about the professionally managed equity and bond portfolios. This money manager is PTS Money Management. They're a tactical investment company, meaning that they want to do the same thing as with Clark Capital, where they want to participate when the market's going up and go to safe haven when the market's going down. They're an asset company. They're a registered investment advisor. They have over 70 years experience between their management staff, and they do a very good job, as you'll see when we go through the presentation. The keys to investing, successful investing, is first of all, capital preservation. So if you don't lose it, you don't have to make it up. In this case, this just shows 3 years of investing, making 15% a year, 3 years in a row, and the third year losing 35%. So if you went up 15, 15, and 15, you went up 45%, and you lost 35%, offhand you think you're ahead. But actually what happened here is the account went from 100,000 way up, lost to 35%, and then after that it went back to a loss, and all the gains wiped out. That's for the capital preservation. Then we also look at consistency. Here we have two portfolios, A and B. Portfolio A made 20% the first year and the second year. The third year it lost 20%, and the fourth year it made 20%. So that's 60% gain, 20% loss is a 40% gain. Investment B, more consistent, 10% gain for 4 years in a row. They both made 40%. So which one made the most money? Well, if we look at investment A, that returned $138,000, $38,000 gain. Investment B, $146,000. That's a 21% difference in the amount of money you made in your portfolio over those 4 years and being more consistent. So consistency is one of the keys. That's the first part of it, is capital preservation and consistency. So we'll look at the step 2 of the investment process. If you look at these different areas here, you'll see that this divides its money up between bonds, international stocks, and domestic stocks. In doing so, this goes back and says in 2008 they took a very defensive position. The position being they felt the market was going down. Maybe it had time to be in some cash, sometimes it would be in money market, sometimes it would be in bonds. In this point, of their different portfolios they have 3 different portfolios, conservative, moderate, and growth. Their average weighting was 91% in cash during 2008 when the market was getting beat up. Step 2 is proactive process. When you have a market going down, at some point it's going to turn around and go back up. In this case, this shows in 2009 when the market had bottomed out and turned around, they started going back into the market, not all at one time, but gradually going back into it to get back invested in the market. One of the biggest problems I find that people have is when the market goes down, they hang in there, and then at the bottom they get fearful and they sell. And whenever they do get back in, they wait, and then when the market's way back up again. What I have found is bad things happen when the market's high, and good things happen when the market's low. So when is the best time to buy? The old saying is buy low and sell high. Who actually does that? Most people sell when it's low because they're fearful, and they buy because when it's higher because they feel, oh, I gotta get back in because I'm going to miss it completely. So good things happen when the market's down. Bad things happen when the market's up. Here's an actual chart looking at their growth portfolio. If we look at this, in November of 2007, you'll see they're about, just about 50% cash, maybe 40% and 30% in domestic and 30% in international stocks. And then as the market started to go down, which it did, the high was in 2007, they went to about 75% cash and 25% international. The next move they make, and you can see the dates right here, they went to 100% cash, and then they made another change here, went to partially cash, partially stocks, partially bonds. That was in November 2008, and it looked like maybe they made a mistake, and then a couple weeks later they went back to keeping the bond positions and raised more cash. The market continued going down, but the bonds started to settle out a little bit, and they had about a 50-50 mix. Then going into January, they added a little bit more stocks. Mm-hmm. And then in May of 2009, they added more position. So what they're doing is they're saying, yes, we want to manage our allocations when we're going to be in stocks, when we're going to be in bonds, and they don't do it in the type of thing where they're jumping around a lot, but they do what the market will give them, what the market dictates. The market's going down, it's a hard place to make money. Market's going up, it's time to be invested. Here's the crust of this portfolio, which I really like. If we look at the different investors for different portfolios, we have a conservative, moderate, and growth. If we look at this chart here, this gives you an outline of their portfolios or their criteria, their limitations, what the portfolios have. So if you look at the conservative portfolio, it says that at any time they can be invested up to 40% in domestic stocks. They can be as high as 40% in global stocks, and they can be as high as 70% in bonds. But if you notice the blue line down at the bottom, they can be 100% cash. Mm-hmm. So when the market's getting beat up, they'll put more money in the bonds, more money in cash. When the market's going up, they'll put more money in stocks and bonds. But being conservative, they'll be more balanced. Moderate, same criteria, except the limitations. They go up to 60% in stocks, both domestic and global. That's up to 80% in bonds. In growth, they can go up to 100% in stocks, 100% in bonds, 100% in whether it's global or it's domestic stocks, or 100% cash. So they have a little bit more leeway. That's the reason why in 2008 they did so well compared to the stock market.
So they have people on staff that sense this and they study these trends?
Well, what they're looking at is they're looking at the indicators in the market. There are always indicators in the market. It's just how you interpret them. apparently they do a pretty good job of interpreting them. And yes, their job is to protect the money when the market's going down. That doesn't mean you're not going to have a loss. It just means you keep the losses to a minimal, and to be invested in the market when the market's going up. Now, this isn't like you pulled up to the traffic light and you have red light stop and yellow light caution and green light, you can go. But it's something similar to that, and they pay attention to it, and they do a good job, which you'll see in a moment. It's very simple to implement the program. We could, they also, if you have a 401k or you have a variable annuity or a variable life insurance contract, they will also manage that for you if you want. Most of my business is people with IRAs, 401ks. They roll into IRAs, give them more options and more latitude what can be done with the assets. This chart here shows PTS management. It shows their account, and this versus the S&P 500. The blue is the S&P 500, and the red is this account. And if we look at this, they look for long-term success and risk management. And the way to do that is to keep the losses to a minimal and keep the gains in line, being competitive. If we look at this chart, the blue is the S&P 500. You can see how volatile that was. And this is their portfolio in the red. And we can see at the beginning of the chart, the market went up and they went up. The market went down, they went down. The fact is they didn't go down as much as the market went down. Then when they started back up, they started from a higher point and they went up, and the market went up, and they actually ended up pretty much breaking even there at one point. And then in 2007, the market really got hit, and they didn't. But look at the difference in the amount of money $100,000 started with in the portfolio. Wow. Now, if you were taking money out of that account, I can tell you this much, the difference would have been even bigger. So this is assuming you never took any money out of it. So when you're taking money out, having consistency and keeping the losses to a minimal is of the utmost importance. The next three charts we have here are on their three different programs. One is the conservative portfolio, and it gives you the years they had and the returns that they had. What I find is a lot of people key in on the years 2000 to 2002 and 2007 to 2009, because that's when there was a lot of volatility in the market. And if you compare this to the S&P 500 or other accounts, I think you'll be happy with the results that you have here. So this chart's on the conservative portfolio. The next chart is on the moderate portfolio. And you'll see the same thing. It did a little bit better than conservative, and 2008 it lost a little bit more, but the other years it made a bit more. And the third chart is the growth portfolio. What I like to key in on here, if we look at 2008, and this is something you compare directly with the S&P 500 is the benchmark that it uses. This account lost some money. It lost 13%. The stock market, the S&P 500, lost about 37%. So which would you rather have? But more importantly, if you look at 2009, the stock market bounced back. The S&P 500 bounced back somewhat, and they made about 26%, where this one here made well over 30%. Wow. So it did better in the good times and did better in the bad times. So consistency is important. And the last chart is just a composite of using all three portfolios and what the returns were with all three portfolios. Some people will take a look, and they'll take a look at something like this, and they'll put a certain amount in conservative investments because they want to draw money out of it, and put an amount in growth because they want to get more growth to give them a little bit of edge with the market. So it depends on what your alternatives are, or what your objectives are, your goals are, on how the money gets divided up. Again, there's a little plug for PTS, and they talk about having 20 years successful record, and certainly I think if you look at these slides and the proof of it, that you'll probably agree with that. Where do we go from here? You can download, if you're on my internet viewing this video, you can download the equity and the bond portfolio review. A number of these charts, and they may be updated by the time you get them. They'll be there for you to take for your review. You can contact me for additional information. My name is Paul Fair. Paul Fair Associates is a registered investment advisory firm working with retirement solutions for people. So my website's paulfair.com. Take a look at the website, and I hope to hear from you soon. Thank you.